Kevin Smith is back with us. He's the founder and CEO at Crescat Capital. Good morning, Kevin. I want to talk some gold with you first because one of the charts that I've been so focused on here on the program has been gold's slight kind of softening of momentum that we've seen over the last month. Yesterday, it seemed like Jay Powell gave the same message that he has been, ready to cut, ready to add to the balance sheet. And gold ended the session off the highs, and we're still well off the year-to-date highs. What's going on?
Well, as you know, gold had a pretty good run for the 3 months prior to last month's pullback, and we're very constructive on gold. And it, we heard yesterday from Jay Powell that essentially he's ready to increase the balance sheet again. So this, though he won't admit it, it's QE4 that's already started with this liquidity crunch that we've had with the repo increase that you've seen already.
So, Kevin, when we talk about the announcement that he made yesterday, I feel like there's still so much stigma attached to, the idea of QE as sort of this, rescue effort, right? Post-financial crisis. But they did make regular tweaks to short-term rates and add to the balance sheet before financial crisis too. So should investors be considering this as a cautionary sign, or is that going to have to be, still determined?
Well, the truth is we're record late in the business cycle with asset bubbles abounding, and when you get late in the cycle and the Fed starts cutting rates, as they've already done twice now, it's usually for a good reason, and that's because the economy is slowing. The global economy is slowing, and there's a negative fundamental backdrop. So can the Fed get out in front of it? Really, ultimately, we think the QE that's to come is going to be because there's real financial crises that are developing, and so it's not that these little adjustments that we've seen so far are anything major. Certainly, it's more what's to come that's the issue.
Let's talk about that, because this is where I think it gets really interesting. Because if you had told me that last week we were going to fall short of every ISM number that we were looking for in the U.S., and if you had told me that, again, Jay Powell and central banks would wax dovish, I would think there'd be a fire under gold. But Kevin, given how the narrative was so powerful for both bonds and gold for so much of this year, I'm wondering if the market is telling us, kind of from a technical analysis perspective, that things are going to have to get incrementally worse this morning gold's got its mojo back, no doubt about it. We've got a nice bid into it, up about 15 again. But what's it going to take then if the worst ISM manufacturing in 10 years, the worst services in 3 years, and central banks cutting is not, enough to get gold back to the highs?
Well, gold is ultimately driven by money printing and declining real interest rates, which include the rising inflationary component. And until we really see the money printing come back in full force, and until we see inflation really start to pick up again, gold is not going to get its mojo back in a big way. But initially now we are seeing that real interest rates are declining just because nominal interest rates are coming down even before inflation is starting to show up. And so that's still a very bullish fundamental backdrop for gold, and gold is historically cheap relative to the global fiat monetary base. And so I think we're starting from a good place, and we're just going to have to be patient, but it's early in the bull market for gold, we believe.
Kevin, this is a little bit of a curveball, but I'm curious what you think about it, because I've paid a lot of attention to Bitcoin over the past year, talked to a lot of Bitcoin people, and a lot of the cases that you hear for owning that digital asset, they call it the digital gold. Can we ignore the crash that's happening? If you're a gold bug, can you ignore what's happening to the Bitcoin bugs who are getting slaughtered over the past 3 months, down 30% off the highs? Is this concerning if there's some degree of macro overlap between what drove Bitcoin and what also drives gold? Is there some kind of move like this coming for gold?
Cryptocurrencies are abundant, unlike precious metals that are limited in supply, and While Bitcoin had a first mover advantage that's limited in supply, you have all these other cryptos that have come out as well. So
Okay.
I think Bitcoin has that first mover advantage and is an interesting play perhaps to own a little bit as a similar play to gold. But is gold going to have a collapse similar to what Bitcoin did? There was that August of 2008. Correction in precious metals that we had in the middle of the downturn. So back then, so even in a real crisis, even gold can have a liquidity crunch. But I think the comparison to cryptos is there's a lot of reasons to compare them and to think that they're similar.
Sure.
Gold is truly unique in that it's had hundreds of if not thousands of years of history as central bank money.
Yeah. Okay. Good perspective. Kevin, when we relate this to your thesis about China and the debt burden and the possibility of further currency devaluation, the way I think this all ties in is that if the events of the past week and a half haven't been enough to get gold and bonds back to new highs, then will it be U.S.-China related? Are we learning that this is perhaps the biggest catalyst for the need to own some of these safety trades, whether it's anything from bonds to kind of the gold or Bitcoin, anything along those lines? Is it going to come down to the stress in China?
Well, when we look at the big debt imbalances in the world, we think China is just first and foremost the largest credit bubble the world has ever seen. And they've created over $40 trillion worth of assets in their banking system. Since in the last 10 years, that's 400% growth, actually, since the global financial crisis in their banking system, which is about 2.3 times the size of the U.S. banking system for an economy that's 36% less. So it's really a credit bubble of its own that is in the process of unwinding. And we think it is a globally contagious credit bust. So
how then will we know if it really is turning south? I know you've got some really interesting charts here. One is about the general debt pileup as a percent of GDP in China. The other is how much people are spending to service that debt. It's been steadily climbing for a long time, and it looks like it's kind of flattened out here over the past year and a half. So what's happening? What will tell us when it's untenable?
Sure. And what you're looking at there is the Hong Kong private sector credit to GDP growth and imbalance at over 300% today, or close to 300%, which is really one of the largest private credit to GDP ratios in the world. And it's the rise in that over time that the Bank for International Settlements calls the credit to GDP gap, and it's a warning signal that precedes financial crises. And it was a similar warning signal we had in 1989 in Japan when their real estate and stock market bubble peaked out and then burst. It was similar to what we had in the '97 Asian financial crisis when we had Thailand and South Korea and Indonesia currency crises where the currencies devalued 70%. It's similar to what we saw ahead of the global financial crisis with the different housing bubbles in the U.S. and in Europe that built up. Those things and the amount of debt service ratio is another early warning signal that's been rising and it's very high in Hong Kong today, that the BIS warns about. So these are some of the concerns that we have today.
Yeah. Kevin, before we let you go, when we consider the possibility of what this means for currency devaluation, that was obviously a price negative event for risk assets earlier this year. We know it happened in 2015 as well. Is the possibility of some kind of trade truce have the same function as a sort of stimulant from a sentiment perspective? If there is some resolution in trade, can that stave off China's problems in the intermediate?
A trade truce could possibly hold things off. The Hong Kong dollar has been pegged for 36 years, but we think it's actually getting ready to break because of its imbalances there. And today the markets are up because China says they want to do a partial trade deal. Well, I don't think the U.S. is ready to do a partial trade deal, but who knows? I mean, Trump has held that football out for many times, and then he seems to pull it away. And we are not as constructive about a trade deal happening because of bigger geopolitical issues between the U.S. and China. But anything is possible. But we think that it's the credit imbalances in China and Hong Kong that will lead to the financial crises. Trade deal or not aside, we think China is its own credit bubble that is in the process of bursting.
All right. A cautionary note here as we kick off the morning. Kevin Smith, always a good conversation. Glad to have you here. Appreciate it, Kevin, the founder and CEO of Crescent Capital.